Students, you are welcome to the PLBC virtual class simulation. I am Dr. Abdusalam Abubakar from the Department of Economics, Umar Musa Adwa University. Our subject is economics, and we are going to discuss international trade and balance of payments. If you recall, in our earlier topic, we discussed the national income. National income of a country grows over time. And this national income growth can only be experienced or recorded through buying and selling. Companies produce goods and services. Consumers buy these goods and services and make use of them, and then they produce further goods and services. That is how an economy grows. Now, what you should understand is part of this consumption, purchase and consumption of goods and services is also done by foreigners in an open economy. It's not only people in Nigeria that purchase goods and services produced in Nigeria. So also, the goods and services we use in Nigeria are not only produced in Nigeria. So therefore, we engage in what is called external trade or international trade, buying and selling goods and services across borders. Now, international trade is buying and selling an exchange of goods and services between two or more countries. Therefore, this brings in the concept of export and import. If we buy this camera from China, if we buy our cars from Japan, if we buy our televisions from UK or United States of America, this is called import, isn't it? Because we are buying goods and services from other countries. The examples I've given are goods. The services example are if a particular Nigerian citizen went to Egypt or India for medical care, that is also import, isn't it? Because he take Nigerians' money, change into dollar, and go and enjoy health care elsewhere. So that's importing services into Nigeria. Similarly, we also sell goods and services to foreigners. We sell our crude oil, isn't it? We sell our cotton and many other goods and services to other foreigners. That is called export. So more or less, the major components of international trade are export and import. Now, we should be able to differentiate between domestic trade and international trade. International trade involves one or two countries, but domestic trade or local trade is within a particular country. If somebody comes from Lagos to buy tomatoes, to buy goats, to buy beans from Katsina, that is domestic trade, isn't it? Because it doesn't involve crossing borders. And also, he uses Naira to pay for the goods he's purchasing. But in international trade, we use US dollars, isn't it? So also, mostly goods and services that are involved in international trade are maybe machineries and other high consumer, high-tech equipments. Although in the case of Nigeria, we even buy light consumer goods from abroad. But in many cases, imported commodities are not light commodities. Then, government control. In many countries, government places many controls, as we are going to learn later on external trade, for some reason which also we are going to highlight in due course. Then, sources of revenue. Government makes a lot of revenue from external trade. They levy taxes, tariffs, and so on, custom duties on goods that are imported into Nigeria from other countries. Now, basis of international trade. There are two major bases of international trade, and these are exchange and specialization. Now, we start with exchange. Basis of international trade. We have export versus import. We have exchange and then versus specialization, or rather and specialization. Okay. Exchange arises because of difference in resource, endowment and availability, and as well as difference in production cost and prices. So exchange takes place when countries supply goods they produce relatively cheaply and buy odd-demand goods they produce relatively cheap, that are produced relatively cheaply elsewhere. For instance, Nigeria is endowed with crude oil, and by virtue of this, we can produce crude oil relatively cheaply than Japan or than China, for instance. So in Nigeria, we produce crude oil, and we exchange it for goods that are produced relatively cheaply in China, for instance. So we sell crude oil and US dollars and use the US dollar to import goods from China. So this is exchange. Then on the other hand, we have specialization. This specialization is based on what is called the law of comparative advantage. That is a popular economist called David Ricardo. He is the one who proposed this particular theory. This theory of comparative advantage states that countries specialize in producing and exporting the goods that they produce at relatively low cost than other countries. And then the law is based on the following assumptions. So if Nigeria can relatively produce crude oil cheaply than UK, that is United Kingdom, and UK can relatively produce cars cheaply than Nigeria, then UK should concentrate on producing cars and we concentrate on producing crude oil, for instance. So this particular theory is based on the following assumptions. You know, in economies we have many assumptions, isn't it? That is why we have this principle of ceteris paribus, isn't it? All things being equal. So we have to hold some things constant for us to be able to build our theories. So the first assumption is there are only two countries involved. For instance, Nigeria and United States of America, for instance. And then there are also only two commodities involved. For instance, crude oil in Nigeria and computers in the United States of America, for instance. And then labor is the only factor of production, for instance. And then both countries have equal available labor force. So also both countries have equal efficiency of labor. And then there is no transportation cost. In addition to other assumptions about this particular theory. Now based on this, let us have a particular scenario, a particular production scenario. Assuming Nigeria has 10 workers who produce 40 barrels of crude oil. On the other hand, Nigeria has 10 workers who produce only 2 units of computer. So in simple terms, Nigeria has 20 workers, isn't it, or laborers. 10 produce 40 barrels of oil and 10 produce 2 units of computer sets. On the other hand, the United States of America has 10 workers who produces 45 barrels of crude oil. And on the other side, they have another 10 workers who produce 8 units of computers. From this particular scenario, the United States has absolute advantage in the production of both crude oil and computer, isn't it? Because 10 workers produce 45 barrels against 40 of Nigeria. 10 workers produce 8 units of computer against 2 of Nigeria. So if the United States should exercise this absolute advantage, then the global trade will collapse, isn't it? Because Nigeria will have nothing to exchange for the computers and for the crude oil. So now, based on the principle of the law of comparative advantage, this particular scenario will play out. Nigeria will devote its 20 workers to produce 80 barrels of oil, because each 10 group of workers will produce 40. If you have 20, they produce what? 80 barrels. On the other hand, the United States devote 15 workers to produce 12 computers, because 10 produce 8 computers. So 15 will produce what? 12, isn't it? 8 plus 4, that is 12. Then they devote only 5 workers to produce 22.5 barrels of oil, because 10 produce 45. So 45 divided by 2, we have 22.5. So if you have it this way, this means the global economy, which consists of only these two countries, will have 50 barrels of oil sorry, we have 102.5 barrels of oil, isn't it? As against if the United States alone is producing crude oil and we also produce it using all our advantages, the global economy will end up only having what? Only having 85 barrels of oil. So you can see the global economy is better off by specialization and division of labor. So if this happens, Nigeria is going to produce 50 barrels of oil, or is going to have 50 barrels of oil and 3 computer units. And the United States is going to have 52.5 barrels of oil and 9 computer units. So it means both Nigeria economy and the United States economy are better off through specialization, through exercising or practicalizing the law of comparative advantages. So through specialization, as I said, both countries are better off. Both countries are better off. So the conclusion is this: Nigeria has comparative least cost advantage in producing crude oil, while the United States, on the other hand, has comparative cost advantage in producing computer sets. So the United States should devote most of its labor or resources to produce computers, and little of it to produce crude oil, while Nigeria should devote all its resources or labor force in this case to produce crude oil. And then we exchange, we trade off, isn't it? We get these 3 units of computers from United States and give them some barrels of oil. How many barrels we give them? 30. Each unit of computer is equivalent to 10 barrels of oil. So we give 30 of barrels and get how many computers? 3. So we are left with how many? 50 barrels and 3 computers. The United States use 5 labor to produce how many barrels of oil? 22.5. But they get 30. So we now come to a particular important concept in international trade, which is called terms of trade. Terms of trade is the rate at which a country's export exchange for her imports. It is the ratio of export prices to the import prices. So index of terms of trade is equal to price of export over price of import times 100. So this is terms of trade index. Terms of trade is equal to price of export over price of import times 100. So this is called terms of trade. Okay, now let us go back to our example of computer and crude oil in between Nigeria and United States of America. What is terms of trade? What is the export? We export 30 barrels, isn't it? To get how many computers? 3. Which means the terms of trade is what? 10. 10 barrels to 1 computer, isn't it? So we can equally compute this in terms of money, isn't it? We can say, okay, this is $30, this is $3, or vice versa. So we determine our terms of trade. Do we have any question? Any question? Class? What we discussed so far, do we have any question? So let me quickly recap in the absence of any question. We have discussed the concept of international trade, and which we identify export and import as the major component of international trade, and exchange and specialization as the basis of international trade. And we have discussed a scenario between the United States of America and Nigeria with endowment of labor that produces crude oil and computer set. At the end of the scenario, we conclude that Nigeria has comparative advantage in production of crude oil, while the United States had comparative advantage in the production of computers. So each should specialize in its own comparative advantage, and then we exchange, and then both countries are better off. So let us have a break here before we resume. Thank you. Class, we are continuing our discussion on international trade and balance of payments. Earlier on, when we were distinguishing international trade and domestic trade, we said in international trade there is government regulation. And this government regulation is carried out through some trade policies, which we are going to discuss now. The first trade policy or instrument that is used by government to regulate international trade is what is called tariff, or import duty or custom duty. This is a tax imposed on goods and services that are being imported into a particular country, and this in order to reduce the volume of these goods and services imported for some reason, which we are going to highlight later on. The next set of policy package is import quota. Maybe the local capacity to produce rice is 1 million metric ton, but the local demand is 1.5 million metric ton. If we are not to import any, we are going to have problems. Scarcity and the price will go up. If we are going to allow importation anyhow, our capacity to produce 1 million also will be killed, because foreign competition will kill our local production. What do we do in this case? Quota. We now give quota to import the remaining 500,000 metric tons of rice we need. So in this case, the government will give quota to some companies and businesses for them to import the rice or any other commodity for that matter. Then we also have what is called import licensing. This is an authority paper that is used by government to import specified goods and services. For instance, in Nigeria, as we know, we import refined petroleum products. But is it everybody that will just go to any country and buy petroleum and bring it to Nigeria? No. Isn't it? Companies have to be given license by government in order to import refined petroleum products. So this is an example of licensing also. If you are given a quota, then also you are given a license to import that particular quota. There is also preferential duties. In this case, can I continue? In this case, different duties are charged on certain category of goods in order to discourage or encourage their consumption. Usually, luxury goods are tariffed high. For instance, perfumes, alcoholic and beverages, and other shoe, expensive wristwatches, and so on. They are not consumer, they are not basic goods. So government can tax them high, can tariff them high. So also, there are some goods that will be tariffed low or even zero in order to encourage their importation. So this is called preferential duties. There is also the exchange control. This is used to control acquisition of foreign exchange. We import goods and services by using dollars, isn't it, particularly? So you get dollar from CBN and other authorized money changers. So therefore, government can control who and who will get the foreign exchange. For instance, currently in Nigeria, there is official exchange rate. So if you are going to import goods that the government wants you to import, you will get the official rate. If you are going to import goods that are not allowed or that are discouraged, you will not get the official exchange rate. So that is exchange control. Then also reduction in excise duties. This is reduction in local tax on local goods to encourage their consumption against foreign goods. Every commodity produced in Nigeria pay what is called excise duty. So if government wants to encourage the consumption of local commodity and discourage the consumption of foreign one, or if government want to make the domestic or local good competitive, the government will reduce its tax such that it will be cheaper and can compete with foreign goods, and then Nigerians can consume it, and then we have more production of it and more employment. Then also we have import monopoly. In this case, only government or assigned company can import a particular controlled commodity. A typical example is, for instance, uranium. We know uranium is used to produce atomic bomb or nuclear bomb. So it's only government to government that can transact in uranium globally. So a particular individual cannot go to Niger Republic, for instance, and buy uranium. So this is called import monopoly. Devaluation. This is the reduction in the value of currency relative to other currencies in order to encourage export and discourage import. Nigeria can devalue its naira such that when people want to come and buy goods from Nigeria, it will be cheaper And when they export it in other countries, it will be cheaper there, and we produce more and export more in order to create employment, wealth, and to record economic growth and development. There is also embargoes, outright banning of importation of certain category of commodities. Recently, Nigeria banned importation of some category of medicine, especially cough syrup, or is it codeine, what they call it, because it is being abused. Some people are using it as illegal drugs. So this is an example of embargo or ban. The government will outrightly ban the importation of such category of goods or services. There is import deposit scheme. In this case, companies that are willing to import certain goods or services are required to deposit the funds they are going to use for the importation with central bank. And then central bank will be giving them approval to withdraw the money and import, so that they are not allowed to import whatever they like into the country to the detriment of the Nigerian economy or any other economy for that matter. What are the objectives of these trade policies? Why should government engage in restricting imports and encouraging exports? The first objective to achieve is self-sufficiency. If you leave your borders open and everybody is bring into your country, you will end up not being able to produce anything, because the foreign goods will compete away local production, like what we experience in Nigeria. Some of us know when we have UNTL, Dampuntua textile, fabric, and what have you, but they are no longer being produced, and we should know the cost of that. We lost jobs, we lose foreign exchange, and many more. So in order for the government to protect these industries, and in order for us to be self-sufficient, especially in the production of food, government embark on these trade policies. Because as I said, if you allow the importation of everything, we end up importing anything and not being able to produce anything. And then we are insecure, especially in terms of food, which is wrong. Then production of infant industries. I have cited the example of textile industries that close up in Kaduna and Funtua, for instance. Such industries are playing a lot of role in the growth of Nigerian economy, in providing employment, but because we allow them to face competition from cheap commodities imported, cheap textile commodities imported from other countries, they are no longer producing, for instance. So in order for us to protect such industries, we embark on trade policies. Another objective is prevention of dumping. Some countries can produce some goods and services and export and sell them at a cheaper price in Nigeria or any other country than in their own home country. If that happens, we have what is called dumping. It also has negative consequences. Government also embark on trade policies in order to solve the problem of balance of payment. We are going to discuss the concept of balance of payment. When we come, we'll understand what it means better. Then, protection of welfare of the people. Like in the case of the banning of importation of codeine and related medicines. If you allow it to continue, our youth continue to take that as a drug, they are becoming addicted, they are not going to be useful to the society, to themselves, and they are going to constitute a nuisance. So their welfare and that welfare of their family and the Nigerian society is going to be compromised. So in order for us to protect the welfare of this category of people, we employ a particular trade policy in order to protect them. That is why Nigeria banned the importation of such commodities. To recover the economy from depression or recession. Recently, Nigerian economy experienced recession. That is, decline in the production of goods and services. When we want to revive the economy, we block importation and encourage local production through trade policies. Protection and creation of employment, that is very important. When you finish school, whether secondary, polytechnic, college of education or university, the aim is for you to get employment, whether self-employed or formal job. If companies, there will be problems with our youth, because if you are not employed, the tendency is you are going to engage in antisocial behaviors. So therefore, these are some of the objectives of trade policies. Now, we come to the concept I've skipped, balance of payment. Balance of payment is the statistical record of all economic transactions, both visible and invisible, between reporting country and rest of the world. with a specific period, within a specific period. In essence, it is a statement of income and expenditure, export and import. We export goods and services. When we export goods and services, we sell abroad, we get money, isn't it? We also import goods and services. Now, if we export goods and services was 1 billion naira or $1 billion, but import goods and services was $1.2 billion, it means we are going to pay more than we receive, isn't it? Where are we going to get the balance of $200 million? It's a question mark. It's a problem. So in that case, we have what is called balance of payment deficit. But if we export more, get more money, more dollars, and we are to pay less, then we have what is called balance of payment surplus. And that is good for an economy. The economy, and a normal economy, is supposed to be in balance of payment equilibrium or even surplus. That means we are exporting more than we are importing. Now, the component of balance of payment are these. We have what is called the current account. The current account contains a record of expenditure and income of countries' export and import of goods and services. And it contains also investment income from abroad, or we pay to abroad. So it's just like an account of you, an individual. The money you receive, the money you spend. So also a country has an account. The money it pays, the money it receives from export, from import, and other sources of income to the country. So these records constitute what is called the current account. On the other hand, we have the capital account. The capital account records transactions involving international movement of financial assets, foreign direct investments, loans and grants. Nigeria borrow money from abroad. Nigerians and Nigeria government and other economic units invest abroad. They buy financial instruments, shares, bonds and other financial assets. So also foreigners come to Nigeria and purchase other financial assets. So this movement of money involving buying and selling of financial assets constitutes what is called capital account in international economics. Then we also have international reserve account. This international reserve is called also cash account. And this is the balancing item which reconciles statistical inequalities between capital and current account. So if Nigeria sells so much crude oil and we get so much money, we take some part of it and keep in our foreign reserve. We all know foreign reserve, isn't it? Or cash, international cash account. And this cash account is usually in US dollar, pound sterling, euro, and in some cases even in precious metals. Okay, now we come to balance of payment disequilibrium. If, as I've given an example, the money we receive is equivalent to the money we pay, we have what is called balance of payment equilibrium. But if the money we receive is more than the money we paid, we have balance of payment surplus. And if the reverse is the case, we receive less than we pay, we have balance of payment deficit. So this disequilibrium, as I said, is a problem for an economy because you have to find where to get the balance and make that payment. Then what are the causes of this balance of payment disequilibrium? Or rather, balance of payment deficit, for instance. What are the causes? One of the causes is fall in export. If for any reason your export falls, it means the money you are receiving from abroad decreases, isn't it? That means you may end up in balance of payment deficit because the receipt has declined. Low technology or use of crude implements is another. Like in the case of Nigeria, we use low technology, especially in the agricultural sector. We are still using hoe, isn't it? Which is very crude and simple. Other countries are using tractors, harvesters, planters, and so on. So it means our productivity will be low, our export will be low, and then we end up having balance of payment deficit. Low industrial production. Many industries in Nigeria are closing and others are producing below capacity. For instance, our refineries are producing below capacity. So if this happens, it means we are going to have balance of payment deficit, because we are exporting less and we are importing more. Higher tax for foreign goods and services. It is common among Nigerians to regard foreign goods better than local goods, isn't it? So if people have propensity to consume foreign goods than local goods, it means export will be low and import will be high. So we are going to have balance of payment deficit as well. Inflation. Increase in price of goods and services. If the prices of goods and services in Nigeria increases, it means our export will be expensive and we export less and then we will receive less. So we are going to have balance of payment deficit. And then high unilateral transfer. Making transfers, whether in form of donations, whether settling our debts and what have you, then such also is going to lead us to balance of payment deficit. The reverse of these causes will lead us to balance of payment surpluses. For instance, rise in export will lead to balance of payment surplus. High technology and using modern implements will also lead to balance of payment surplus. High industrial production will lead to balance of payment surplus. High or bumper harvest will also lead to balance of payment surplus. Low tax for foreign goods will lead to balance of payment surplus. Deflation, that is decrease in price of goods and services, will also lead to balance of payment surplus. So also low unilateral transfers. Now, if you have either balance of payment, adjust it. How do you overcome it? So we take some measures in order to adjust our balance of payment problems, deficit or surplus. One of these measures is exchange rate policy. An exchange rate policy involves altering or changing official foreign exchange rate through currency devaluation or revaluation. That is, decrease or increase of the value of currency in terms of value of currencies of other countries. When we want to overcome problem of deficit, we devalue our currency. When we devalue, our export will be higher, then we overcome problem of deficit. When we want to overcome problem of surplus, maybe it's too much, we want to overcome it, we revalue our currency. When we do that, we discourage export, we encourage import, which means we are going to have tame the surplus. Another policy option to adjust balance of payment disequilibrium is exchange control. This is currency exchange. This can be fixed, floating, or a mixture of both. If we are using fixed exchange rate, we say, okay, $1 should exchange for 350 US dollar. That one is fixed exchange rate. The government will fix that. We can also use floating. In this case, we allowed the value of dollar to be determined by market forces. Or rather, we can combine both. We can do what is called managed floating. The Central Bank of Nigeria will intervene and manage the value of Naira vis-a-vis United States dollars. So this is also done in order to achieve balance of payment equilibrium. We can also employ some economic policies. The popular among them are monetary and fiscal policy. Monetary policy involves tampering with the amount of money in circulation in an economy. That is supply of money, and as well as interest rate. So if there is inflation in Nigeria and then there is balance of payment deficit, Central Bank can take some measures to reduce the amount of money circulating in Nigeria through many instruments. We have open market operation, we have moral suasion, we have reserve requirement, we have discount ratio, and many more. So these are some instruments of monetary policies that are used by government or respective authorities in order to adjust balance of payment disequilibrium. On the other hand, we also have what is called fiscal policy. Fiscal policy involves changes in government expenditure and taxes, government revenue and taxes. If government want to stimulate economic growth, stimulate export or local consumption of goods and services, government will increase its expenditure. Contractors will get money, they will pay laborers, people will get money and spend. Or government can reduce taxes so that personal disposable income we discussed earlier will increase, and then people will have more money to spend. Aggregate demand will increase and the economy will rebound, and then we are going to move out of recession or problem. Now, this is balance of payment, it is equilibrium and disequilibrium, and how it is adjusted. Now, you see, it is popular adage to say that the world is now a global village, isn't it? You are here, you can buy goods and services in any part of the world, and they will be delivered to you. So also, you can sell goods and services to any part of the world, and you deliver it, and you receive your payment. In addition to this, economies and countries also are becoming more integrated. So this brings us to the issue of economic integration. Economic integration is the merging to various degrees of economies and economic policies of two or more countries. And this is in order to achieve enhanced trade, enhanced economic growth, enhanced welfare for the citizens, and what have you. And this economic integration can take many forms. The common one is what is called free trade area, where two or more countries allow goods and services to be sold among themselves without charging any tariff. But then allowed each country to go and negotiate its bilateral trade agreement with other countries. On the other hand, we have what is called custom union. In this case, countries allow goods and services to be sold without tariff among themselves, so also they have common tariffs against other countries. Then we also have common market. In this case, in addition to the features of custom union, the common market also allows free movement of labor and capital. It means you can go to the Niger Republic and work and sell, you can go to the Niger Republic and borrow money, and so on and what have you. Then we have what is called economic union. Economic union, in addition to all the features of common market, custom union, then we also have to harmonize our economic, social, political, environmental policies. A typical example of economic union is European Union. It's a group of about 25 to 26 countries. Tariffs. So these in essence are forms of economic integration. Do you have any question or contribution? Any question or contribution? Specific to what we have discussed and generally to economics. Okay, in the absence of any question, we conclude this topic. Thank you.